Hello and welcome to the new series of Drishti IAS. I am Pooja Dwivedi and today we are going to discuss a very important topic, that is marginal cost of funds based lending rate. By hearing the name MCLR, you must all be confused. I mean confused in the sense you must all be thinking, oh, this is going to be another boring segment, or we are not going to look at it. But I will try to be as brief as possible in order for you to make sure that you do not get bored, and I will also try to make the concepts clear. I will try to make it very brief yet crisp and understandable. So marginal cost of funds based lending rate, this is very important for us in order to understand from the perspective of prelims. The concept is also very important when we talk about preliminary examination. Basically, certain concepts in economics are very important, such as base rate, such as MCLR, bank rate, reverse repo rate. Everything is going to be important from prelims perspective, the conceptual clarity. And from the mains, we have to understand the analytical part. So analytical part is more important from the perspective of mains. Why are we discussing it? State Bank of India was keeping its MCLR pretty stable since the last 3 years. Now it has changed its policy. The soft interest rate has been changed by increasing the MCLR, which is a little higher than other banks such as Punjab National Bank, Axis Bank, ICICI Bank. From there, SBI has increased it to more than 7%, and that is something is going to be of concern to those who are already paying EMI on their proper loans. So let's begin with what is MCLR. Very simply, I'm going to make you understand over here, because the simpler it is, the more beautiful it is. It simply refers to the minimum lending rate that is set by banks or affiliate financial institutions for any type of loan. It is the minimum rate that the banks are at the luxury of setting in order to provide loans. It could be 5%, 6%, 7%. And MCLR, it replaced the base rate system, which was there until 2016 to 2010. MCLR came into existence on 1st April 2016, okay? And it specifies the procedures which are crucial for determining the interest rate on loans. Why do we need MCLRs? MCLR is linked with repo rate, first thing. That means it is much more harmonized in nature as we compare it to the base rate. MCLR also has given responsibility and accountability features to the banks who were lending to whomever they want at whatever rate they were wanting to. That made of course the bad loans to accumulate, and that is the reason the banking system underwent such a big crisis in the last 10 years. So you see, MCLR first harmonizing through repo rate linking, secondly making the banks accountable to whom they are lending the loans. So this is very important feature of MCLR. Banks and financial institutions calculate MCLR on against certain criteria. First, tenor premium. Tenor is the time length for which any individual or company has taken the loan. The longer the tenure is going to be, the more the risk is going to be. So on that risk, we have to calculate a premium. The banks have to calculate a premium. Premium, that means what are the risks with respect to lending long tenor loans. So first, that MCLR is calculated against this. Secondly, operating cost of bank. Operating cost of bank can include the cost with respect to salaries, the cost with respect to electricity, maintenance cost of keeping so much amount as deposits. Now, negative carry on cash reserve ratio means cash reserve ratio is the amount of liquid money that the bank has to keep with itself in order to make sure that if any crisis occurs with respect to bad loans, the banks have enough money to provide to the depositors. They cannot give away. If a bank is taking 100 rupees deposit, it cannot give away 100 rupees as loan. What if the person who has deposited 100 rupees comes to the bank and says, I want my 100 rupees back? So banks have to keep a certain amount with themselves. Negative carry on cash reserve ratio means no interest that is going to be earned on cash reserve. That means if the banks have cash, a lot of cash, they can lend the loan and of course earn interest on that, or they can park it with RBI and get interest on that. So the negative return on CRR is also there, and the marginal cost of funds. So these are the many features on which the bank calculates MCLR. What is, if we talk about the base rate system which it replaced, certain features of the base rate system, let's see. The rate of interest for loans were determined by base rates. Now it is MCLR, which is linked with repo rate. Repo rate is the rate at which the banks take loans from the RBI. The RBI lends to the banks at repo rate. Okay, calculation for the base rate depends on certain factors like the rate of bank deposits, earnings, bank's operating costs. For MCLR, I have already told you what we are going to calculate our MCLR on. Then repo rates set by RBI were not mandatory. Banks did not always comply. MCLR is going to comply with the instructions of the bank with respect to repo rate, and that is why more harmony between different banks. It's not like bank X is going to put their own interest rate, bank Y is going to put their own interest rate. That is not going to work, because in order for our economy to be well integrated, we need harmonization with the help of MCLR. Moving on, the banks could choose to change the base rate quarterly at their discretion, which is not so with the current MCLR system. There was an absence of transparency and accountability. Again, not so with MCLR. So these were actually the needs why we had to replace the base rate. Moving on. First, I hope you all are belonging to such families which might have to take loans for home, education. If not, then well and good. But majority class, I'm talking about the middle class. So middle class families take loans, house loans, education loans, vehicle loans. You must be paying equated monthly installments, that is EMI. So for EMI, people who ever have taken loans, EMI will rise. How? Because SBI raised the MCLR by 10 basis points across tenures to 7.1%. That was 7% earlier. Now MCLR, which RBI instituted, this has already been talked about, so we'll cut that. It is applicable to fresh corporate loans and floating rate loans, not fixed rate. Floating rate loans before October 2019. RBI then switched to the external benchmark linked lending rate system, where lending rate is linked to benchmark rates like repo or treasury bills. These are certain facts. In simple terms, I'm going to tell you that whenever marginal cost of funds based lending is increased, that means the interest rate will increase, right? When interest rate will increase, the people who were able to get loans at lower interest will now be taking them as at higher interest. The accommodative stance of the RBI is now changing. That means the RBI now does not want a lot of money to be there in the economy. That is why they are increasing interest rate. More the interest rate will be there, less the people will go for loans. Okay, less number of people. Okay, and the higher the MCLR, the less the people take loans, the less the amount of money in the economy, and the less the amount of money in the economy means the less the demand. That means supply will have the time to match the demand. If I put too much money in the hands of many people, it will be too much money chasing too few goods. And whenever there is a mismatch between demand and supply, inflation will increase. And we see what is the entire scenario with respect to inflation in our country right now. CPI is consumer price inflation is 6% approximately. WPI is 14% approximately. So the inflation needs to calm down. This is one of the moves. Okay. Moving on. If we talk about, this has already been taught, so I'm just going forward. The extraordinary liquidity measures that were taken with respect to pandemic period. In the pandemic period, because people had less income to purchase anything, be it home, be it vehicles, pursue education. So what did they do? They did not demand much. That means supply was a lot and demand was not a lot. Even so, there was not a lot of depression. Our country did not see depression. But here we see that the banks infused a lot of money with respect to many infrastructural projects. The government also did so. So a lot of money made the economy into a liquidity hangover. That means the amount that has been invested, that has been invested, the cost of the company or the cost of the project has not risen to match that investment. That is the liquidity hangover. So that also needs to calm down. We need to calm down the supply of money, and that is why MCLR is being increased. Okay, with retail inflation, this has also been discussed. Moving on. Now, there is also a repo rate hike to be expected. Repo rate is the rate at which the banks borrow money from RBI. Okay, so this is the RBI, this is SBI and XYZ, whatever bank. When the repo rate will increase, what will happen? Repo rate is the rate at which banks borrow money from RBI. When repo rate is increased, the less the banks will go to RBI for asking money. The less they go, that means the liquidity will be less. They will have less cash to lend. When that happens, the liquidity in the economy will be sucked by RBI. Okay. Whenever RBI wants more liquidity, it will decrease the repo rate so that more and more banks can come and ask to RBI for the money, because now they have to pay less interest on whatever money they have borrowed, and then they will give that money in the form of loan to the customers. That means more liquidity and more supply of money. More supply, that means that could be more inflation if it is not managed well. So simple as that. Now, when repo rate will also be hiked, that means liquidity will be impacted. So on April 8, the RBI's Monetary Policy Committee restored the policy rate corridor under liquidity adjustment facility, standing deposit facility at 3.75 as the floor for this corridor. Standing deposit facility is basically at the rate at which the banks, if they have excess money, they can park it with RBI so that they can earn interest on it. Okay. SDF is an additional tool which is employed by RBI to absorb excess liquidity. Now, I am SBI, I have too much money. Now, what do? RBI will tell me, okay, you lend me the money in the form of SDR and I will pay you the interest, so that my money, which is in excess, goes to RBI and not to the customers. That means less liquidity in the economy. Then analysts and bankers, they expect the RBI to increase the repo rate from 4% in the June policy review. Now, as we know that since the last 11 Monetary Policy Committee meetings, RBI has not ever touched the repo rate. Now it is going to do so in order to keep this in check. Okay, and deposit rates will also rise. That means right now, if we talk about inflation, depositors are at a loss because the value of interest that they are earning, the purchasing power of that money is getting reduced because of inflation. Now here it says deposit rates are likely to increase meaningfully over the next 2 months. SBI now offers 5.10% interest in the 1 to 2 year bucket. Deposit rates in 1 to 3 year bucket have fallen from this much to this much. Not very important, just to give you a gist of it. What to do? First of all, for any person, like I am also a middle class family person, so I know that if I have to do certain things, like I have to take a loan, what will I do? I will not go for certain loans which are of less tenure. I will go for a longer tenure period so that I can pay it in very small amounts for a longer period of time to keep my peace of mind intact. Why? Because inflation. We can increase the tenor on the loans and make some amount loan prepayment. Suppose I have to give or take a loan. Suppose I have to take a car, okay, and I have 5 lakh rupees. I will try to make at least 2 lakh rupees as down payment, so that I know that whatever the amount is remaining, I can turn it to a longer tenure loan, so that MCLR affects me. It will impact me, but it will impact me at a lesser frequency. Okay, this can be done. Let's move on and talk about the question. What is marginal cost of funds-based lending rate? How does an increase impact the economy? Okay, write in 250 words. Just wait. I told you that I will take the names of those who have answered it correctly. Let me do so. The first thing that we have to keep in mind over here is yesterday's question was with respect to Ayurveda, right? So yesterday's question, first statement was correct about Atharvaved. Second, it wasn't by Sushrut. It was by Vagbhat. Okay, so keep that in mind. And in order to make sure who have answered it correctly, I will take the names of those. Okay, Sonia has answered it correctly. Okay, and then Jen Sakhi Modi has answered. No, she hasn't answered. Sorry. Then comes yes, Dinesh Pradhan has answered it correctly, and many people have answered it D. D is not the correct answer. It's A. Okay. Then Achinte has answered it correctly. Mukesh has answered it incorrectly. Umesh has answered it correctly. Debroti Das answered it correctly. Pallavi, Nibha, Anuja has answered it incorrectly. It should be A. Okay. So Manjunath again answered it incorrectly. It's okay. You can do this. It's not like who have answered it incorrectly is like completely at a loss. It's not like that. You will learn through this only. And I enjoy interacting with you all. So keep on answering. Okay. So let's meet in our next segment soon. Thank you so much for watching.